All right, we're gonna kick it off, and we'll just let people join as we start. Just be mind of the time, and we're recording anyway, so it doesn't really matter. So great to see everyone. For everyone who's new and welcome, the idea of these weekly calls is pretty simple. These are not webinars, they're not a pitch, and they're definitely not, I'm gonna full disclaimer, this is not investment advice. This is just a place for thoughtful investors to slow down things a bit and think a bit more clearly on what we're actually doing and what's going on. So we're not telling anyone what to buy or how to predict the markets. We're here to talk about frameworks and trade-offs and how we all make better decisions in a world that it's getting more and more complex, and of course more complex than just simple stocks and bonds for the masses. And the way this usually works is we're going to start with just a quick market recap, just context, like not opinions or anything. I mean, we will, but just don't listen to them. And we're going to spend most of the time on a focused topic today. I am super excited. We're going to dive into fraud in private markets or Ponzi schemes in particular, and we're going to open it up. So please interrupt us, disagree, push back, questions. Mike is here with me. We do these calls together. Mike is a super experienced investor, and we've been friends for a couple of years now, and we've been doing some podcasts together. So please interrupt. This is not a webinar. I don't want people just to sit down and just put questions in the chat. Just like unmute yourselves, ask questions, and feel free. We are recording this and we're going to send it afterwards. So if you're live, jump in. And for those who are listening to the recording, I'm going to share a link in the description so you can join the future calls live. All right, that's enough of me rambling on. Mike, anything before we dive into it?
Nope, let's go. I'm excited to get started.
All right, so I'm not going to go over the whole market recap because it hasn't been such an interesting week. I'm not talking about geopolitics, just markets. I will say two things that have been interesting the past week. Bitcoin and Ethereum or crypto in general is ramping back up a bit. Bitcoin is about 95,500, so it's a pretty high growth over the past week. Ethereum as well. But I think the biggest gainer, and unless you're under a rock,
Richie.
sorry, oh, um, unless you're under a rock, is silver. Like silver is surging like crazy. Went up 30% almost from last week. So, or from the beginning of the year, sorry. But so pay attention to those types of stuff. Unemployment and jobless claims, things are going down. Don't know if these are signals or not, but let's just keep pay attention to them as we continue to go into this interesting year ahead of us. So that's sort of markets. Now, let's dive into the core of the conversation, which is fraud, Ponzi schemes. But before that, right, Mike and I were talking about this before the call. You know, there's basically, generally speaking, two ways to lose money in the private markets. Investing in a bad deal because the operator didn't underwrite it properly, they took too much risk, whatever. These are good people, but they just made a mistake, or the market's twisted, or interest rates go up 5x and they didn't anticipate that, or all these other things that happen in the market that we all know of, but this is not a bad actor. It still sucks. I had a conversation with one of our clients the other day, and they're invested in a fund that went bankrupt, and it sucks. There might be fraud there, but there might not be. And so not every time we lose money, it's because of someone lying or scamming us. We're not going to talk about that today. We're going to talk about that in other sessions we dive into. What we're going to talk about today is more around the second reason people lose money, which is bad actors, fraud. All right. And this is where it really sucks because it's been happening a lot over the past couple of years when people made a lot of money during the zero interest era, and it was really easy to make money. But then when things shifted, you could either, face the music, or you can go down a bad rabbit hole and start to lie, steal, scam your investors. Or worse than that, it wasn't even set up in a proper way. It was all a Ponzi scheme. And the goal for us today is to try and identify, understand, and have an open conversation about identifying these types of things before investing, red flags that are around the Ponzi schemes or fraud in general. And then once we're already in it, I was talking with my co-founder Tomer, the other day about he's invested in this fund that's just doing amazing over the past couple of years. He's been invested probably 8 years, and he always had this sort of hinge. This is too good to be true. It's all good. And we were having a conversation with Mike as well. It's like, wait, hold on, I need to go and check this. And Mike, I didn't tell you this, but he sort of like started to search, like going down this rabbit hole looking background on this operator and found out there's a lot of lawsuits against them and a lot of sort of red flags in different countries around Europe, and they're not allowed to sell products in the US. So it's like holy shit, why didn't we think about this, or why didn't he look into this before he invested in all that? So
Right.
um,
Yeah, and just because there are lawsuits doesn't mean that this isn't a good investment, but it's a red flag, and it's the type of thing that where he needs to be concerned with it and look into it more. And if he hadn't invested already, that would be something that may make it to where you don't want to take that risk. But now that he's in, he's got to decide, okay, what can I get my money out? What do I want to? It's going well, but is it real or is this a fake fraudulent thing?
right, all right, so let's start from the top. All right, so before investing in a deal, again, private markets, it doesn't matter if it's private equity or private credit, but it's the private markets because there's not as much transparency and there's not as many regulatory requirements. What would you look at, or what do you look at before investing in a deal to identify this is not fraud, this is not a Ponzi scheme?
Well, I mean, I think a lot of times when we talked about things on other calls, we talk about how in the end, the most important thing is the operator. That's going to be more important than the specific deal or anything else. That's one of the harder things to really investigate. So a lot of times I don't use that as that's my most important final screening tool, but it's easier to screen out some things based on the asset class, where it's at, the deal itself, because those are quick and dirty and you can eliminate a lot of things. But when it really comes down to it, the most important is the operator and making sure that they have that reputation. Like it sounds like with Tamar, if he had done a deep search on things, he would have been able to see that there were some lawsuits. And then you start digging more into it to try to see, okay, is there value to that? Because it doesn't mean that just because there's a lawsuit, somebody's a bad operator, but it's a yellow flag and it's a, hey, I need to look into this more and figure out is this worth pursuing or not?
Yeah, and there's also a really, hard aspect of investing in the private markets, which is, it's basically a lot of herd mentality. In all these groups we're all part of, we hear about different people investing at different deals and different operators, and we think, well, if a lot of people are investing with this individual, with this firm, then they're probably legit. I'm not saying it's not a good indicator. I'm just saying you have to take it with a grain of salt in a sense and do
Yeah.
dive deeper, right? Because, you know, we've seen a lot of people invest in different deals based on what other people they feel like, oh, this is a good thing. A lot of people investing, people I trust. So let's not do the due diligence and let's just trust these other people and their judgment. Even more
Well, the
so,
other thing,
I just want more, even more so when we look at like in our platform and the data that we have, and we look at people at operators, we have these two soft metrics: how many people have invested with them, and how many people have invested with them more than once. But when you think about just those two things, it's an indicator, but that's not enough, right? It doesn't mean this isn't fraud or this isn't a Ponzi scheme, right? Even more so, that's the whole goal of a Ponzi scheme is get more and more people investing because the more people invest, the more money you make because you get more returns from those people, right? So anyway, we were talking about identifying it before, right? So obviously it's vetting the operator. You're betting on the horse, on the jockey, not the horse or the race itself. What else? Like, all right, so what else can you look at before investing to make sure this is
I
not?
mean, that's a lot. That's a lot of it is just sort of looking into those things. So, as a comment about other people that investing, that's a great screening tool. But where I see people get in trouble is when they say, "Oh, Litan invested, therefore it must be good. I'm going to invest too." Because one, the biggest reason not to do that is because you may have completely different goals, and something that I may want to invest in because it really fits what I'm looking for, may not work for you. It doesn't mean it's not a great investment for me. It just means that it doesn't fit what you should be adding to your profile of investments at this point in time. So that's the biggest reason. But the next part is I do think there's some that herd mentality can be good as long as you don't take it too far. So the fact that other people like it is an indicator, okay, this is something maybe I should look into. But like I have, for example, a couple of my friends, there's one of them, he seems to like everything. And so it's like, if he liked a deal, it didn't really matter at all. Versus I've got another friend who he really doesn't like very much. He's really kind of pretty grumpy and doesn't really like deals. So it's like when he liked something, I'm like, oh, this guy likes it. I should probably take a closer look. Versus when the other person says it, I'm like, yeah, he likes everything. And most of the stuff he likes, I'm not into.
So I agree, but let's try to get away from intuition because intuition doesn't really help many people, I'd say,
Sure.
right? I only invest with people that are good friends because I trust them, right? That doesn't help. I don't have any friends
Yeah.
who invest and are GPs in anything. So how would you recommend, like, how would you recommend when you hear about a GP and not a deal, like the way I see it is the deal itself, the fund doesn't matter obviously as much as the operator, the manager, or the GP. How do you go and vet that that GP is not fraudulent, is not a scammer, is not starting a scam, or will not go and scam you when the shit hits the fan?
Right. Well, one of the things you and I and Tamar talked about the other day is that as a fund gets to a certain size, I start to have expectations. So if the fund is, 10 million, 20 million, I don't necessarily expect it to have an outside auditor. But by the time you get to 50 million of assets, I expect that you're going to probably have one. By the time you're at 100 million, it's a big red flag if you don't. And so that's the type of thing that, depending on the size of the raise, what is appropriate for a $5 million raise is very different than somebody who's doing a fund and raising 80 million. And some of those types of things, and having standards of what you look at that way.
Have you seen names of auditors that are you know more reputable than others? Because we know the Madoff story. He had an auditor, but
Right.
it was one auditor for one client, and so that doesn't really mean much. But
Right.
have you
Yeah,
heard
they
of?
didn't exactly that particular situation. The guy was in his building. He was the only client, and there wasn't this ongoing relationship that they felt like they needed to that they didn't that there was too much influence over this one thing. So you want to go with like a top four, a top six, a top 10 auditor, ideally, because they have a reputation to maintain, and the reputation that they have built up over decades is more important to them than any one client, because there's always this sort of like, if you don't like the auditor, you can change and you can get a different auditor, and there may be reasons to do it. um, and that's the type of thing that it's not necessarily a red flag, but it's something like, oh, it's worth looking into. Why did you change auditors, after 2 years with this other company? And if they're getting to somebody that's more stringent, more better reputation, that's probably a good thing. If it's somebody that they're going down the stack and it's a no name that you've never heard of before, that's a little more concerning.
All right, so that's like like a first objective way to identify red flags around an operator that might, at least give us a confidence that this is a serious operator. They're getting audited properly by a reputable firm. What else? I'd say, if you go back sort of to searching the internet, and now with AI, it's so much easier now to go and ask whatever Gemini, Grok, ChatGPT, or any of these AIs out there to do deep research about the name of the managing member, the managing, the GP or whatever it is, the name itself, the name of the firm, to go and do some background checks. Like I remember, I think Jeremy Roll, who's like a big, private market analyzer or whatever, at the
Yeah.
beginning, he used to hire private investigators to go and do background checks and
Yeah.
go
And
and
I've done
kind
that
of
too.
yeah. So you can do that and go spend the money on that, but let's just say most of us probably will not. And so this the lowest hanging fruit, or the next best thing is to go and do a good search. And I think what's important about the search isn't necessarily obviously lawsuits and all that, but one of the things that you see with fraudsters is they might have already had a different operation with a different name, and they went bankrupt, they closed it, and then they started a new company, a new firm with a different name, starting fresh, so that the unsophisticated investors will believe it without going and doing the research and say, "Oh, wait, this is the same person that either lost money or scammed a bunch of other people, or was like in the gray area," right? So I think that's also another good way to sort of identify if this is a good bad operator, right?
Yeah, you can. The other thing that a lot of times you can look at is, hopefully you're working with somebody who has a track record. They've got deals in place and that kind of thing. So you can ask for, send me the last 3 years worth of communication that you've sent out to your current investors, that type of thing. And if somebody's reluctant to do that, that's, again, it's not necessarily a stop, but it's a big yellow, if not, light red flag, that type of thing. If you're in a national group like you and I are, the type of thing where you could say, hey, I'm, anybody in the Kansas City market that can, run by this place and take a look at these two places that they've been operating for a couple of years, walk them, see how it looks, that kind of thing. Calling, to see like you're let's say it's multifamily, calling like you're a tenant, checking in on things. And again, you can decide how much you want to do, but a few little things like that can often, if it's a true fraud, you can find out that it's not a good operation. It's things aren't being run right. that type of thing. I mean, I've gone to the point where when I was raising money for a fund of funds, we sent people to the individual, there were two offices, one in San Diego, one in New York City. We sent people in there. They owned about, at that time, maybe 16 companies across the country. We divvied it up, and several of us called the companies to talk, to people at the companies, how long have you been owned by them? How are they? That sort of thing, to just sort of make sure it's right. Through connections, we actually not only knew what auditing company did their audit, but we contacted them and were able to get a hold of the actual auditor that did the audit and talk to them. So do I do that on every investment I make? Absolutely not. But if it's a lot of money, or especially if you're kind of taking a herd mentality and there's 10 of you looking into something, you can divvy things up and get a lot more detailed like that.
And I think this sort of pulls me back to the like 30,000 feet where many of us are just trying to be passive investors. Like I want to be an LP investor because I do not want to be active in my investments. And so a lot of people I assume will be hearing this like, shit, forget it. I don't have the, like, I wanted to be passive. Why are you telling me to go tour a property and go to an office to see that someone's actually there? I think that it's really important that to understand at the front end of these passive investments, there's a lot of active work. But once you find that jockey, you find the person to bet on, the GP you can trust, that's like 95% of the effort is vetting that firm, that individual. After that, it's just like the deals, the numbers that come in is analyzing them and making sure that those are matching to my strategy. So yes, this might sound very active to find and vet these operators, but once we're done with that, and it's really important to do some extent of it, we're pretty much in the black when it comes to probably not a scam, right? Someone we can trust. But it does sound
Well,
like Mike, when you explain it, it does sound a bit overwhelming.
yeah,
Uh,
and again, I'm just telling you the most that I've gone to the efforts to, but I normally don't do that for a typical investment. The other thing, just to tout Vyzer a little bit, is you guys have access to you know hundreds of operators and deals and that kind of thing, and you're seeing how they're communicating. Are they paying? Are they keeping up with what is expected? And so, I think you're getting to where you're going to be able to release more of that information to your users. So things like that can help too, to just not necessarily say this is somebody I want to invest with, but it's a way to sort of screen it down to people where there's going to be some more safety. The biggest thing that I would say, though, that to go back to what can still go wrong, is that I think a Ponzi scheme is a lot like, a turkey with a turkey farmer. It's like every single day makes you more and more confident. Every day the turkey, the farmer loves him. He's feeding him, he's taking care of him, he protects him. Everything's great until the day that he chops your head off and eats you. And that's the way the Ponzi scheme is too. Like the longer it goes, the more you feel confident. It's like, okay, I've got friends that have been getting paid for 2 or 3 years. I mean, the average Ponzi scheme flames out at about year 4. But if you look at, say, like the ATM fund, that was 9 years in. Madoff was longer than that. So some of these can go much longer before they blow up. And that's where you can have things that would normally tell you this is good actually are working against you. You're closer to the end.
yeah, but the end only arrives when you have a black swan event, assumingly, right? And then a lot of people just start to tap in and get their money, want their money back, and then you
It
can't.
can. Well, and again, there's things that are and so like the ATM fund, I think we can talk about it as a Ponzi scheme, and because there's things that we know of that we know the SEC and the FBI are investigating, but we're not going to name names on or kind of like give anything because it hasn't been made public yet. Something like the ATM fund has been out there in the paper enough that I think we're safe
So
to
hold
sort of
on,
talk about that.
before diving into that, let's maybe frame because I assume most of us know what a Ponzi scheme is, but let's just frame it so we're all on the same page, right? Do you want to do it or should I?
Well, okay, yeah. So let me take an example of somebody that I know that happened to them. So bad operator that had a business plan and they bought the building but what they did is they didn't do the work. They stole all the money from the construction, and they didn't do any of the things they said they were going to do, and they siphoned off millions of dollars, and then they just bailed. That sort of thing. Like that's fraud. And that's somebody who came into it initially with fraudulent intentions, and there's theft and fraud involved, but it's not a Ponzi scheme because no one was paid. Versus if they had gone from one deal to the next and tried to like prop up the first deal by giving money from the second deal to the investors of the first deal to make them feel more comfortable, that paying initial investors with later money is where you get into what we're calling a Ponzi scheme.
Right, but if we go down to the pure definition, basically, you don't even have to buy any assets. You just raise capital from one investor, and then another investor invests, and you pay the first investor back profits from the money the second investor just invested with you. And so
Yes.
you're required always to raise more money in order to pay out the
Oh,
older
good.
investors the profits.
Oh, oh, one of your tax forms. Okay.
All
Did the
right.
package?
Yeah, sorry, someone keeps that. So that's like the pure like Madoff style, right? There was he did not buy even a single stock with the money he raised capital from. He just kept on paying out so-called profits from the money he raised from other people. That's a right. That's a policy.
I would say Madoff did both. Madoff, I think, started out legit and then got behind and then went fraudulent. And my understanding, at least, is that he was still doing some trades all the way along. It's just that the trades didn't equal what he was saying he was making, and he had cooked the books all the way along. And he just got further and further behind until it was complete fraud. And I think like the ATM fund is that way too. At the end, there were supposed to be 32,000 ATMs in existence. There were somewhere between a few hundred and maybe 3,200. I've heard, official counts on different things, but there were some out there actively working, and you could go to the Jersey Turnpike and find them, and, go to a bodega in Philadelphia and find them, that sort of thing. But, there wasn't anything close to what was really supposed to be there versus what you're talking about. Like my understanding of, for example, the carbon capture that was going on, that was completely fraudulent.
Let's talk about that for a second. I don't think people are aware of that fraud.
Yeah, it was somebody had some technology that they said that instead of when natural gas comes out of the ground, it's not ready to be burned in sort of its current state. There has to be a process going on to it. And so under normal circumstances, you ship that off to a giant gas refinery, and then they clean it up and it goes. This person had supposedly created this system that did it. You could do it for a single well or a small batch of wells, and then it was ready to go. And there were supposedly, they were creating these machines, and they had these solvents that were made out of coal that were, how they did it, and they were sequestering it, and you got carbon capture credits from it, and all these different things. In the end, it seems as though that was 100% fraudulent. There wasn't a single machine. The technology didn't exist. There wasn't a single machine that worked. There was one machine in somebody's backyard that were, some people took pictures with a couple of times, but it was never an active thing. And so that's one that's different, where there wasn't anything really of basis there. It was a completely made up thing, versus something like the ATM, or like we talked about the cattle, where there was supposedly 80 some thousand cattle that were being raised. There really were some cattle, but it was somewhere between a few thousand and 10,000. And so the vast majority of what people said they were doing to make the profits and to return money to people wasn't there. That it was never that profitable. And they were instead, the main money came from new investors coming in, hearing about it, and then paying the old investors off.
So there's a bunch of different underlying asset classes that you just mentioned, right? From, let's just say, stocks, the Madoff scenario,
Yeah.
to carbon offsetting, cattle, ATMs. If you look at the common denominator, it's very hard to go and touch the underlying asset and
Yes.
count how many exist. I assume, and because we also talked about real estate, I assume underlying assets that are more some sort of regulated, or it's easier from a compliance standpoint to find and identify them. There aren't as many Ponzi schemes around that. But going back to those examples, if you were talking with an investor before investing in those deals, what would you have asked, or how would you have identified that this is not legit? This is probably a Ponzi scheme.
I don't think you can ever know that it's probably a Ponzi scheme. There's things that make me more nervous. And so if it's weak or weird collateral, that's something that makes me look into it a little bit more. If it's something that is, and again, not all tax forward strategies are bad, but I have seen a lot of Ponzi schemes lead with some sort of a tax savings, that it's a tax first, investment second type thing. that's another thing. And again, it doesn't mean that there's a lot of investments are tax forward and they're perfectly legit. It's just another thing that I've seen, a lot of things go kind of that way. But I don't think you can ever know for sure. Like I was telling you the other day, like I had a client that it was a group, and it's been named, so I'm not going to name the name, but it's out there. But it was a Atlanta-based business that was taking money, bringing it in from investors, and then loaning it out to businesses, business loans, and they were paying a 12% return, and they were supposedly loaning out at 16 to 18 and keeping the difference for themselves. And they'd been going for years. And one of my clients wanted to invest in it. And so, I hadn't heard of it before. We looked into it. I told him that here's were my questions. We met with somebody that was there. And this was a $140 million fund that had been going on for 8 years. And they didn't have they couldn't give me a loan tape. They wouldn't share at all who they had made any single loans to or who had paid them back or where the status was on anything. Again, doesn't mean that it's bad. It's just like that's not a good sign. They also had no audits. Like there wasn't a single auditor. I'm like $140 million fund. You should have, that's that old. You should be having an auditor of some sort. And so there were about a half a dozen things. And when I got done to it, I'm like, look, I don't know that this is a Ponzi scheme, but I gave them all the reasons. I'm like, here's how it could be, and here are the reasons that if I was creating a Ponzi scheme, these are how I would set some things up that would make it easier to hide. And so I advise you not doing it. And about 8 months later, he sent me an article one Sunday that's like, yep, it came out, and it's like Ponzi schemes can go on a long time, but if you had invested in year 4, you would have felt like you were fine for the next 4 years. You're getting paid your 12%, everything's fine. Every single month you're getting your payment of 1% of the money you've got invested in there, just like clockwork, until one day you wake up and you figure out it's all a fraud and you're not getting anything back.
So, so if we go sort of more like methodology, look at the operator, background check them as broad as you can, either on your own or hire someone, right? And then that's you'll find some maybe red or yellow flags, and then the deal, track record, other investors, and also the underlying assets to try and understand what is the collateral that this fund, this GP or this operator is strategically going to invest in. And the looser the collateral, the higher the risk,
Right.
right? Um, there's a lot of talk around the performance of a deal, right? If someone's promising you performance, or if historically they've always done well, beating the markets, like I find that to be very hard to cope with because there just are really good operators in the market that have really good returns. And classifying really good returns as potential Ponzi is like, hold on, you're going to go paranoid, not invest in anything, right? So would you agree, like, what do you think about that way of looking at historical performance, beating the markets, being good, really good compared to the markets, and that being a Ponzi scheme?
Yeah, I think you have to use judgment. And again, I'm going to talk about something that I saw last year I was at an investor conference. It was an official, like we're going through the speed dating, I'm the LP, they're the GP, going through the speed dating. And it was a hard money loan fund. And they were supposedly they were paying 16%. And I'm like, how are you paying 16%? Like, that just seems impossible because all the other hard money loan funds that I know of are paying 8, 9, 10, sometimes 11, every now and then a 12. I'm like, 16 is impossible in my mind. And his explanation is like, oh, well, we're in Kansas City. It's a back market. Like there's not as much competition here. I'm like, what are you talking about? Like, that's ridiculous. That is absolutely not. And so it's one of those where it's like, maybe I passed up on a great investment, but I would say, it's just like, doesn't make any sense at all. And like what they were telling me they were doing, like I'm aware enough of what happens in the market that is not a reasonable return. And so there's some of those kind of things that you can just sort of say, okay, this return is not reasonable. This isn't something that anyone is going to really do.
Yeah, well, I think you need to be really good at analyzing deals in order to understand that this is realistic or non-realistic in order to reach that conclusion. Uh,
Right.
but but because there are ways to achieve it, it's just high risk and maybe and
Yeah.
then high returns. But yeah, it does raise a flag.
Yeah.
And
And I've seen things before where they'll tranche out debt And if you're in the first loss tranche of like the top 5% that's going to be in a first loss position, and you could, if they, like if the fund loses 6%, you go completely under, great. You may be making a lot more. You just need to know what risk you're taking. And there's nothing fraudulent with that. But again, you need to understand exactly why they're getting the returns, how they're getting them, and does it pass a reasonableness test. Another thing, there was somebody that was in a group that you and I are, another group that you and I are part of, Litan, that, like they were pitching, one, they were pitching it really hard, but it was a 40% return. And I'm like, okay, well, that's kind of a red flag to begin with. I mean, any sort of consistent 40% return seems unlikely. It's not impossible, but where to me it became completely like there's no way this is right is because you didn't have to be accredited and they would take as little as $5,000. Where if you're really legitimately returning to 40%, you're probably qualified purchaser only. They're definitely don't have salespeople, and you probably have to be putting in, $1 million to 25 million to get into it, kind of thing. Like those aren't just like the things didn't add up. And so the 40% return was the first thing that said, this is likely not valid. But then let me check into a few more things. And it only took like 3 minutes to be like, okay, there's zero chance. And that's another one that 4 or 5 months later, he was in the paper for it. It clearly was a Ponzi scheme. He was arrested along with the rest of the people that were there.
Yeah. And by the way, again, I'm going to mention this, and it'd be great if anyone has any questions or any examples or things that they're in that they're concerned about. We can talk about them and walk through it now. Or if anyone has any other experience that they've been in a Ponzi scheme or any other fraudulent investments, I think it'd be really interesting to hear so we can all learn from it. This is a safe environment. No one's gonna think negative of anyone. It's for us to learn and be better investors. So feel free to chime in.
Yeah, I got a question.
Sure.
Have you guys ever seen sort of like hybrid where they have good intentions from the beginning with their investment, but then the investment starts going sort of haywire and then it sort of becomes a fraud where it starts off
100%.
like a good deal and then it kind of goes back that way?
Yeah. So there's somebody that Latan and I know. I'm not going to name any names or the city that they work in because it's not, the SEC is investigating them, but they have not been charged yet, and the FBI is involved too. But like they had multifamily and they had thousands of doors in multifamily, and then they had land and they had a fund, and it was something where the multifamily, at least what I'm hearing so far from the SEC and the FBI, is that there wasn't fraud there. There was just there was an intent to do well, and then deals just went bad, and basically, let's say there were 50 deals. I think 2 or 3 of them, people are going to get a few cents back on the dollar, but in general, all of the people investing are getting zero. But there wasn't fraud. It was a bad operator who got caught up with things. Now the land, different, because they said that there was going to be no debt. They were raising all of the money. So they're going to buy the ranch for 5 million. They raised 5 million, and they tell you very clearly, we're not putting any debt on this. Well, then they went out and then they put on debt. And then they took that debt and pulled it back for themselves and to pay for things and also to prop up other things. That's fraudulent, but they weren't, that wasn't necessarily a Ponzi at that point in time. And then there was the debt fund, which at least what I'm hearing so far was actually a true Ponzi scheme. They were bringing in new money and they were paying out to existing investors the 10% that they promised. And, new money was paying out old money, and there was nothing actually purchased with that. And it was just set it up. So here's somebody who I think started life with good intentions and started to get behind on things and then started to commit fraud, and they have a Ponzi scheme, and all 3 of them are probably losing, all or most of their money. But the people that invested in the multifamily with this individual, they're not going to get anything back because there wasn't any fraud. It was just bad operator, bad conditions, and they've lost their money. The people in the land and the debt fund may get some things back if they're able to kind of claw it back.
I'd say one of the things that we've seen with people that we know, like personally, like GPs seem legit, seem like they had good intentions, and then when business became very difficult because of the markets and all that, and they were with their back against the wall. And then they stop answering LPs, investors. They stop answering calls, emails. Like they've gone totally, off the reserve. You can't find them. That's sort of when you have a really strong indicator that, oh shit, they might have started well, but then they made really bad decisions. And now, if they're not answering, they probably did some bad stuff towards the end. And that's probably, I'm not saying it's 100%, but that's sort of when one of those like, and we see that a lot. Like people hey, is anyone else invested in this with this operator? They're not answering me. And so we go and we find other people that are invested with the same operator, and we'll connect them to sort of find some sort of resolution through legal aspects or other to just even get an answer. And I think that's a obviously it's after the fact. Like you can't know this before you're investing. I personally think it happens more often than not that people, start legit, have good intentions. From a personality standpoint, they probably aren't, you know, moral enough so that when the shit hits the fan, they're going to be transparent. Because you see really good GPs, even when, things go sideways, they are so transparent with you and so honest. You'll see the investors being, it's all right. We knew when we invested, there's risk. It sucks. Yeah, I lost a ton of money, but at least you're communicating properly with me. And it is so important. When you think about capital calls in the private investment world, in where they're not supposed to be good things, like capital calls in private equity, usually good, right? But in real estate, they're bad. And capital calls happen. But then when you see an operator communicating poorly around the capital calls, that's a red flag. It might even lead to something bad. I think that's my experience. Mike, what do you think?
Yeah, I agree. Like the individual I was talking about, I've met him at investor events before. He had a great reputation. I don't think he was intending to be fraudulent. I don't think that's how he started out. Versus a true Ponzi scheme, a lot of times that's their intent, or at least part of the time. And I think this person just made really bad choices and didn't have the moral compass to admit that there was a problem. What we're talking about here reminds me of somebody else that I've had speak to me at investor conferences before. Through the '08 thing, he had a huge multifamily operation in different parts of the country. And in some deals, in some parts, were going really well still. They weren't as impacted and things were going okay. And in other parts, they was just getting devastated. And he really thought that he could like it was only going to be 6 months or a year, and he could borrow some of the money from these funds that were, or the multifamily operations that were going well, to prop these up and try to make everybody better off. Well, the problem is it wasn't a Ponzi scheme, but he committed fraud, and he ended up being prosecuted and spent 7 years in a federal penitentiary for that. And again, I don't know what his intention was, but he doesn't seem like a bad guy. He seems like somebody that just got in over his head, didn't really understand what he was doing. But in that kind of situation, he's stealing from these people. You can't steal money from these people to try to prop these people up, even if you're trying to do something that's the right thing.
For sure.
That's fraud.
Golan, are you sort of in a deal like that? Are you experiencing something like that at the moment?
No, a friend of mine, he basically did that. He started with good intentions and then just went really bad. And I didn't think it was fraud initially, but it became fraud because of that.
How was
I think
in what way was it fraud? Can you sort of explain? It doesn't you have to say names or anything. How was it fraudulent? What did he do?
I think just then went to raise additional capital to sort of cover the past mistakes, past losses, when that additional capital is supposed to be for more deals. So, just kind of filling the gap. It became Ponzi scheme to just keep the lights on.
Yeah, it's like it seems like a slippery slope, right? Because then you do that, then you have to pay those guys back again.
Mhm.
You have to raise another deal that's paying up. So it's like this cycle that until you pull off the band-aid, you're screwed as an operator if you start doing that. Anyone else sort of experience something like that? Even though we're kind of at time here, but anyone else have any insights we can learn from?
Yeah, I'm curious if anyone is in something or has been in anything that they want to talk about.
Okay, Jacob always has really good stuff. Things are omitted below to protect the innocent. One of my company's lines of business is checking prospective VC investments. This is long. Hold on. Yeah. Well, I mean, you want the GP or the manager to take responsibility when things go sideways, right? So, and yeah.
You actually want them to communicate more.
Yeah.
I mean, in my opinion, a good GP is going to communicate more and more detail to make sure that you know and to take responsibility and those sorts of things. Versus a lot of times people go dark and they're embarrassed. They don't know what to say. They don't want it to be
Yeah,
true, and so they stop communicating.
the thing that Jacob was talking about, though, when you look about the VC world, the tech ecosystem, startups, it's all about a dream. And you're selling. You can say it's fraudulent. Like there was a whole, forget her name, with the whole blood startup. Um,
Right.
it was fraud, right? Because either it's not feasible, or she never intended, or she whatever. She couldn't have. She just sold a good story. But at the end of the day, as a startup founder, your whole existence is built on your ability to sell the narrative and the story. But then afterward, to go execute on it. And if you're really good at raising money, you're just really good at telling stories, right? And so what Jacob said, yeah, when you invest in something like that, you want to bring in a subject matter expert to verify that what this person is actually saying is feasible, right? And just lower.
Yes.
But that's a whole other world. Like VC investing, startup investing is a whole other world. But I appreciate you sharing that, Jacob. We're at time here. I was really,
Litan?
yeah, go ahead, Ken.
Oh, yeah, sorry. I probably just have two quick things I could share. We got caught up in one of these as well. The guy was, as you said before, was one of those assetless or asset light deals. He was trading options. Um, Came to our office, showed us his strategies, gave real world examples. It all seemed legit. The problem was he just wasn't actually ever executing on these trades. He seemed to know what he was doing. He just didn't actually do it. Um, so I guess looking back, a couple things we could have done. Um, yeah, he wasn't accredited by anybody, and I think that was one red flag we probably could have found if we had looked. He was clearly making statements on his own. These weren't. This was some PowerPoint as we looked back that he was just kind of randomly generating by himself. Um, he was a big spender, spent a lot of money, a lot of trips to Africa, donated a lot of money. He was like a little mini Madoff in his own way. And so looking back, I think some of those behaviors and characteristics might have tipped us off. But you were at least to something suspicious, right? I mean, it's hard to identify a pure Ponzi, like you said. But you were talking about character issues. One question that we do try to ask other investors if we're doing reference checks is whether there has been a challenging time or a quarter. How did the sponsor behave during a time of trial? Was he transparent? Did he disappear? Did he try to solve the problem? Did he try to blame everybody else? Blame circumstances around him? You just start to get some comfort or discomfort around these people and how they might behave in a bad time. Because like you said, they may start out doing something right, get in trouble, and think this is a way out. And if if they've indicated the ability to blame others or circumstances, everything's always out of their control. Maybe they fall into that trap and start a Ponzi as well. So sorry, I took too long there, but
Oh,
just a few thoughts.
it's extremely helpful. I appreciate it. It's funny, like when you think of it. Go ahead, Mike.
I was going to say, Ken, did they print or give you any indication of like month by month return
Oh yeah,
performance? Because
yeah.
that's
And
one
it
of
was
the things that I love to see, because like as an investor, you want to see like, oh, they're barely, like the Madoff thing. It's like I'm making 1% to 2% a month, that kind of thing. I'm never having a down month, that kind of thing. But it's like that's not the way the world works, especially if somebody's trading like that. Is like you need to see a year where they only returned 4% and in April they lost 12. Because
right.
that's the kind of stuff that really happens and
Your
in the
smart
world.
fraudster would do that.
Yeah.
They'll throw that in. Yeah. And if they
That's
do,
right.
and I've had things before. I look at lots and lots of deals, but I was looking at a private stock placement on a company, and I kept asking. They supposedly had all these contracts, and I was asking for like I need the copies of the contracts, that kind of thing. Let me see the orders, and it was really tough to get it. And then when I got it, it just seemed off. Like it just didn't feel right. Like, like how much they're ordering month to month and what the orders look like and that type of thing from the different people. It just didn't have a good vibe to it. So again, you have to look at lots and lots of deals, but that was when it's like, maybe it's a great investment and it's going to IPO and people are going to make a ton of money, but there was something with it didn't feel right to me. And so I'd rather say no to 10 deals that turned out to be really good than to get into one that ends up, being a fraud.
Right. Yeah. Yeah. We had a couple other groups that were, they were going to develop some property. They had what they termed to us were leases. We asked to see the leases. They turn out that they're LOIs. They weren't even signed LOIs. It just takes a couple of questions sometimes to find out if things are as legit as the sponsor claims.
Yep.
Awesome. Well, I think I mean, this again, I'd love to continue this conversation, but I think this is sort of where we should pause it, and we can continue also offline if anyone has any questions. I really appreciate this discussion, and it's exactly why we do these calls, like everyone's input. And so, Ken, I appreciate you sharing that. We're going to send the recording of this after the call and everything we talked about. And if it stuck with you or you're thinking about it through, like, again, we can talk about it offline. Next week, we're going to have another call. Unfortunately, Mike won't be able to join us, but we're going to have a call with another good friend of mine, Jay Borgano, who's going to talk about the whole world of buying cash flowing businesses and how that works and operates. And it's a world that's been growing over the past couple of years since real estate has been down. And so we're going to talk about that next week. And as always, if there's any topics you guys want to cover or guests you think we should have, please let me know. These calls are shaped by the group and not by any content calendar. And once again, thanks you all for showing up and engaging, and have a great, rest of your week, and see you all next time. Thanks a lot.
Thank you. See ya.
Let's go!